Well, hello everyone. Glad everyone is with us today. Today we have a special guest, a friend of our channel, Nathan Bollinger. Thanks for being with us again, Nathan.
Mark, thank you for having me.
Today, the reason Nathan's here, we're going to look at a financial concept called all your money every day. It's a phenomenal financial concept, all your money every day. If you've never heard of it, you want to stick around. Nathan's going to show us and explain it on a PowerPoint. We're going to interact, him and I. You're going to learn some good, healthy financial information today. So with that, I'll pass it over to Nathan, and Nathan's going to share his screen, and we're gonna interact together.
Perfect. Thank you, Mark. Hopefully you can see my screen in a moment here. Let me know once that pops up for you.
That's good. That looks good. We're good.
Awesome. So Mark introduced it as the all your money every day, which is exactly right. I'm going to sometimes refer to it as AYME, just AYME as an acronym. So if you hear me
Oh
say
yeah.
AYME, that just means all your money every day. That's the concept we're covering today. Before we get into introducing the concept, I like to start my conversations with clients with
Hmm.
their day-to-day banking, with their cash flow. And the reason I like to start there is I was actually reading a couple of days ago, Mark, that Canada leads the G7 in household debt.
They leave
We
the
are
G7 and what?
in household debt.
Oh, they do. Oh wow.
So not the most, I guess, in the world, but the most in the G7. And if you're optimistic, you could say, well, hey, there's lots of reliance on the housing market. So a more optimistic way to phrase that would say, hey, we're the most leveraged country in the
Yeah, I
world.
think so. Yeah,
In any event, I think it's really important to have a plan with your debt management. So
absolutely.
even if it's just a matter of, hey, we're leveraged, what is the goal here? What's the timeline? How do we get rid of this mortgage as quickly as possible? So
Yeah.
that's why we start with the day-to-day banking. This is what 95 or maybe even 99%, pretty much every single client I talk to, this is what their banking looks like from a high level. The
So
income
that's
gets
what
deposited.
banking looks like.
Exactly. So the top, you have that income. For most people, it's a salary job, but it could be a self-employed. It could be a dividend. You have money coming in. That money that comes in hits that checking account. That checking account essentially becomes your operating account. From there, you'll move money to a joint expense account. You'll move money to your mortgage payment, to your advisor for investments. You'll take cash out. You'll make debit transactions, e-transfers. That becomes, like I said, the operating account for your financial picture. It's
That's
the
right.
quarterback, essentially. One question I want to ask you, Mark, is of all the products you see on this page, which do you think is the most profitable for your bank?
Well, I think it's the your checking account. I think that's what it's most profitable for the banks. Not for
That's
me, but for
exact,
the bank.
exactly. That's exactly right. Now, most clients don't get that right away.
Yeah,
The
that's
most
right. I
common
agree with that.
answers I get when I ask clients that would be mortgages. The train of
Hmm.
thought being, hey, the balances are so high. Yeah, then they are profitable. The other answer we get a lot is credit cards because the interest rate is so high.
Oh
But no, you're
yes.
exactly right. It's those checking accounts. It's those what they call core deposit accounts. And I
Hmm.
know that you know why, but for the sake
Yeah.
of all the listeners, the reason it's so profitable for the bank is they're able to lend that money back out. When you have
That's right.
money in a checking account, it doesn't sit in the safety deposit box with your name on it. It is what they use to finance their mortgages, their line of credits, their car loans, their investments,
Hmm.
etc. So, what do they pay you in return for that? With the typical, I'll ask customers that as well. Say, hey, what is your
Hmm.
bank paying you on your checking account? Sometimes a percentage or two, and they call that high interest.
Yeah,
Uh,
yeah.
other times, actually far more common is clients are paying a monthly fee for this privilege.
I know. I can't believe it. Yeah, I know.
Doesn't quite seem fair. You're paying the bank to hold your money for you. They're turning around and leveraging it multiple times to
Hmm.
finance their more profitable activities. So
Hmm.
the next question I'd ask you, Mark,
Hmm.
is what is your client's most important asset?
Well, when I'm talking to clients and if we're focusing on net worth, um, it's typically the house is the most important asset. From that perspective, I know it's not what you're looking at,
It's a
but
little bit of a trick question, right? It's not
a
technically an asset what I'm looking for, but
trick
what
question.
I'll say probably one of the most important features that your clients have, most important things in their lives would be their
Hmm.
ability to earn. So
Yeah, the ability to earn income.
you'll spend a lot of time helping them build for retirement, so they have some
Hmm.
sort of income stream. You'll spend
Hmm.
a lot of time helping to protect those investments as well, all
Hmm.
because they need to be able to derive that income moving forward.
Yeah.
So essentially, every month or every month over month, week over week, you're depositing your most important asset, your ability to earn income,
Hmm.
into the bank's most profitable product. So I guess what I challenge people here is this banking structure, is it good for and efficient for you, or is it good and efficient for your bank?
Yeah.
That's sort of the question.
Yeah. And the bank, obviously, they structure it strategically for their benefit. And we don't know, the average person has no idea of the things you've just talked about there.
And we'll see a lot of the time a client has a mortgage, let's say $100,000 mortgage, a small one with the bank. At the
Hmm.
same institution, even they'll have 5 or 10,000 sitting in checking or savings account balances. So
Hmm.
the bank's charging you full interest on the money you owe them, and the money that they
Hmm.
have of yours, they're giving you nothing in return. You're essentially borrowing any money you have in those checking accounts.
Hmm.
Essentially, is borrow funds because it's not working for you. I want to talk a little bit about, as a mortgage agent, I get a lot of questions about interest rates, and that's probably
Hmm.
doesn't come as a surprise to anybody. When it comes to a mortgage, there's sort of three main inputs to make the mortgage calculation. And that's the
Hmm.
principal, which is just how much money are you borrowing. That's
Hmm.
the interest, the rate that the payment's being calculated on. And then amortization, which is just an industry term for time. So how
Hmm.
long do you have to pay the mortgage back? How long are we going to spread those payments out for?
Hmm.
Because interest rates are fairly close, everyone in Canada is getting between 3.5 and 6 at any given time for the most
Yeah.
part. What actually becomes the most important factor, if your goal is to pay the least amount of interest,
Yeah.
it's the time that you have the mortgage. So I'll rephrase that. Say if your
Hmm.
goal is to pay the least amount of interest possible,
Hmm.
the time that you have the loan is the most important factor. So that's the
Okay.
lens I look at all my clients through, is how do we
Hmm.
set it up so that we can pay this mortgage as fast as possible and pay principal as efficiently as possible.
Yeah.
10 times out of 10, that's going to reduce your total interest cost.
Well, that's
I'll give
good.
you a very quick example of that. Just a
Hmm.
rough simple one. Let's say, Mark, that you're in need of $100,000.
Yeah.
Bank offers you 3.74 on a 25-year amortization.
Yeah.
Bank number B offers you 4.04 on a 20-year
Yeah.
amortization. Canadians will typically jump at the 3.74 because
Yeah.
that's 30 basis points better. Lower rates got to be better, right? By paying an extra $85 or $90 a month, you're debt-free 5 years sooner, despite the higher interest rate. You've paid $8,000 less in interest, and you have about $500 or $600 back in your wallet every single month 5 years sooner.
That 53,000 and 45,000, is that interest on the loan?
Exactly.
Oh, wow. Wow, that's a lot of interest for just 100,000.
Yeah, that's the deal. You'll see with an amortization schedule if you look at it after you
Hmm.
sign your loan documents or when you're reviewing your loan documents, you'll
Hmm.
see how many years it takes before you really start making meaningful pay down to principal. It's quite alarming in some cases.
Hmm.
This would be the alternative that we would look at setting up, and this is the AYME strategy. So this is the all
Hmm.
your money every day. We're going to take what would traditionally be a checking account, a savings account, a mortgage, and we're going to roll all of it into one account.
Hmm.
So the first thing that we do here, and the first benefit, is that any money you have idle, so any money that you have checking your savings or even cash under the mattress, we put that into the bank. That
Yeah.
is now sitting against what you owe. So your mortgage is at the lowest possible level it can be at once we fund the mortgage, because you don't have
Hmm.
cash sitting around not working for you.
Yeah.
Second is we've now traded a semi-annual compound interest for a traditional mortgage for a simple daily interest calculation that gets compounded monthly. So it gets
Hmm.
posted to the account for the following month. What that means is any deposit into this account is going to immediately hit the principal of what you owe. You'll
Hmm.
get the benefit of a reduced interest cost for as long as that money is sitting in the account.
Hmm.
That's why we recommend, and all of my clients will deposit their entire paycheck into this account. So
Yeah.
it's the money doesn't go through a checking account anymore where it's not working for you. It
Hmm.
gets deposited against what you owe. And
Hmm.
essentially, you're taking a prepayment of your entire paycheck against your mortgage.
Yeah.
Now, it's important to note that you have all the same functionality in this account. This is a full service checking account.
Hmm.
You can do cash withdrawals, you can do mobile check deposits, you can do e-transfers and bill payments. All of the money sitting in there is working for you
Yeah.
until you actually need to use it. So until you actually make that bill payment, even
Mhm.
if it's just sitting there for an extra week or two,
Yeah.
it's working for you because your balance is lower. The calculation they do for the interest charge that day is on a lower balance. You get
Yeah.
that benefit. So this is the concept that we would present. And typically, we would do some modeling for the client as well to say, okay, this is the high level, but let's get into your scenario. Let's look
Yeah.
at your income, your debt level, your expenses. And that's often where clients really see the value. They start to say, hey, we could be debt free 4, 5, 6 years sooner, save X amount of interest by changing the way we approach our banking.
Hmm.
So just to highlight quickly the differences, and then we'll maybe have a bit more of a discussion. But
Sure.
traditional mortgage interest, like we talked about, very front end loaded. So you're
Yeah, it
years
is.
before you start seeing those meaningful payments.
Yeah.
There's also quite a few restrictions put in place with this kind of a standard installment loan
Hmm.
that I think some people don't always appreciate. And there's
Yeah.
limitations on how quickly you can pay in excess of your monthly payment.
Hmm.
So lenders will let you increase your monthly payment, but often they don't let you decrease it. So it's sort of
Hmm.
intimidating. Hey, maybe I could afford it, but you're not quite sure. Also, there's caps to the principal pay down you can do in the way of lump sums as well. In contrast with the AYME strategy, it's simple interest on a daily basis. There's
Hmm.
no limit to how quickly you can pay it down. So there's no cap on how much you can deposit against your mortgage at any
That's
point.
good.
And all of your excess cash flow at any point in time is working for you because it's sitting against what you owe.
Yeah.
The two ways to pay your mortgage faster would
Yeah.
be frequency of payments or the amount of
Hmm.
the payment. So a version of a lump sum.
Yeah.
We often see in the industry that clients will go accelerated biweekly,
Hmm.
and that helps. That moves a couple of years immediately off of the amortization. But they
Hmm.
usually do it just because they get paid biweekly.
Yeah.
So better than biweekly, you have the option to pay this daily if you want to.
Yeah.
And on the lump sum side of things, limitations on how much you can put down. This you can use your entire paycheck. So I guess the question is, how do you pay your mortgage more aggressively than your entire paycheck?
Hmm.
We often see, kind of the last caveat here, I often see is that clients don't take advantage of prepayment privileges.
No, they don't.
The first reason is if you can't afford to. Okay, that makes
Hmm.
sense. The second and far more common reason is they're not sure if they're going to need that cash back. So they'll have 20 or 30,000 that in theory they could put towards that mortgage,
Oh,
or
yeah.
maybe it's less, 5 or 6,000 they could put towards it. But hey, what if I need that money back?
Yeah, that's right.
That becomes part of those limitations where once you pay it, it's gone. With
Hmm.
this program, you can pay it even if you know you're going to need it in a handful of months. Put it
Hmm.
against what you owe, have it work for you, and then once you
Hmm.
actually need it again, you can take it back out of the account.
Yeah.
So that's kind of the high level. We would get again
That's,
a lot more into detail with specific clients, but just for
yeah,
this forum, in the interest of time, we'll leave the presentation there. If you had
that's
any
good. Yeah.
questions, I think that would be a good segue.
Oh, that's good. Yeah, I got a few questions. So, like, obviously, this is a mortgage product, so they have to have a house, right?
Absolutely.
Now, well, what type of clients would you say would benefit the most from this AIM strategy that you just talked about?
If you don't like debt, if your goal is to be debt free as soon as possible, I think it's
Yeah.
a perfect opportunity for us to have a conversation. The prerequisites that you'll need are one, you want to pay your mortgage off quickly. Two,
Hmm.
you have to be earning more than you're spending, at least in the majority of months. So
Hmm.
that's, I think, to be fair, that's sort of the baseline. I think in general for making tangible steps towards financial independence, you want to be
Yeah.
spending more than you make.
Yeah.
But in addition to those clients, I think those who benefit probably even more would be borrowers who are on variable income. So maybe they're
Yeah.
self-employed, maybe they're seasonally employed, maybe there's bonuses or commissions or overtimes, and it's not
Hmm.
the same every single month. We
Yeah.
talked about some of the inefficiencies in the banking structure. It's a
Hmm.
lot worse for those type of borrowers because it's just hard to budget. How much money do I leave in my account when I don't know necessarily how much I'm making next month?
That's right.
This can functionally level out your income,
Yeah.
and it provides a lot of flexibility as well. So in the months where you're making lots, you're paying it very aggressively. In the
That's
months where
right.
you're not making as much, you've already prepaid it from earlier months. It gives you that ability to, like I said, sort of smooth out your income over the year.
Well, that's good. That's good. So another question for you, Nathan. What would be the next step? So let's say someone's like, yeah, I'm really interested in learning more about this, maybe even for myself. What would be the next steps? that someone be interested in this, what kind of like they should take, um, wherever they're at, what should be their next steps?
I think a really important piece, and I'll tell clients too, but if they're listening, they can get a head start on this, would be
Hmm.
an understanding of what your budget is.
Hmm.
So when I say budget, an understanding of what you're spending monthly
Okay.
outside of your mortgage, right, outside of your debt.
Yeah.
What are your standard costs? And you don't have to get into the nitty gritty necessarily down to the second decimal place,
Hmm.
but you have to be confident that you can spend less than you earn. Because if you
Yeah.
don't, this product can work in reverse. It's really
Okay.
important that we have the right cash flow, we have the right income to expense ratio, and then
Yeah.
from there, once we have a high degree of confidence in those numbers we're working with, we can
Hmm.
get very specific in the structure that we set up for you, so we know what's going to
Okay.
work essentially. So that
Well,
would be
that's
the one
good.
request: an understanding of what your budget looks like.
Yeah, and what I'm gonna do, just so everyone knows, to reach out to Nathan because he's a super guy. I'm gonna put his contact information in the content in the comments and in the description of the video, so you can reach out to him. I do have another question for Nathan before we go though. So let's say, would there be any other scenarios where this type of mortgage strategy could be used?
There's a few that come to mind. One that we see is very popular if we
Hmm.
can qualify for it, and sometimes that
Hmm.
can be a challenge. This is
Hmm.
kind of viewed as a premium product in the market, so sometimes getting into it can be take a little bit of time just to build a
Okay.
plan.
Yeah.
But clients who have rental properties love this product.
Oh yeah.
Focus on the rental, and as far as I know, it's the only self-capitalizing mortgage product. So, in sort of plain language, that means you
Yeah.
don't have to make those monthly payments. It's allowed to accumulate in the account. And the benefit
Okay.
there is not that you're just going to run up your debt. The
Hmm.
benefit there is that we get into a conversation of good debt versus bad debt. If you
Yeah.
have rent, if you have rental income,
Mhm.
let's try our best to direct that rental income towards the principal resident debt because it's not tax deductible. So if there's
Mhm.
any real estate investors, you might recognize what I'm talking about as a cash damming strategy, and that's
Yeah.
exactly what it is. This is an extremely flexible solution for that. And then there's other applications of that feature as well. So, it's the sole proprietor with the tax bill. What are they
Yeah.
doing with that $30,000 tax bill while they're accumulating it? Don't put it
Yeah.
into the 100 savings account. Put it against what you owe. Get the
Yeah.
benefit of 5%, uh, basically tax free or after tax dollars.
Mhm.
Um, so I'd say the self-employed borrower, the borrower thinking about retirement, and the
Yeah.
investor
That's
benefits.
good. Well, I tell you, Nathan, this is really helpful. You really know your stuff, and I appreciate that. Our listeners would benefit from this content and understanding the all your money everyday concept, the AIME strategy. But I just want to say, if anyone needs to talk about mortgage related stuff, Nathan's a good guy, and his contact information will be available. So thank you again, Nathan, for helping us educate people properly on financial and mortgage related strategy. So we appreciate you being with us, and we'll say goodbye for now.
I appreciate it, Mark. Thank you.
All right, talk to you later.
Take care.